Now, optimum price is the price at which we get maximum profit. And where is that point? It is where the marginal revenue is equal to the marginal cost. Now, here we have to know two equations. One is the demand function, which is given by P is equal to A minus BQ, and the marginal revenue function, which is given by P is equal to A minus 2BQ. So the only difference between the demand function and the marginal function is there is a 2 here. And P stands for selling price, A stands for the selling price when quantity sold is 0, and B is the change in price divided by change in quantity, and Q is the quantity. Now, whenever you are given a problem on optimum pricing, the steps that you have to follow is you have to first start by finding out B. Now, in the question, two price quantity combinations will be given. So to find out B, all you have to do is you have to find out the change in price divided by change in quantity. Next, you have to find out A using the demand function P is equal to A minus BQ. So here B is already known from step 1. And I said that in the question, there will be two price quantity combinations that will be given. From these two price quantity combinations, you can take any of the price quantity combinations. So you will get P and Q from the price quantity combinations. So the only unknown will be A. So we can find out A. So once we know B and A, it is very easy to complete the demand function because demand function is P is equal to A minus BQ. So once A and B are known, then it is very easy to complete this. Now once you have completed the demand function, then it is very easy to find out the marginal revenue function because all that you have to do is add a 2 here. So if the demand function is 10 minus 0.4Q, then you have to just multiply 0.4 with 2. Then you will get the marginal revenue function. The next step is to find out the optimum quantity. That is where the marginal revenue is equal to marginal cost. Now marginal cost will be given in the question and marginal revenue we already know from step 3. So Q is the only unknown and hence Q can be found out. Once Q is found, then you can substitute Q in the demand equation, and since P is the only unknown, you will be able to find out P. That is what is explained in step 5. Then the question may further ask you to find out the maximum profit. What is maximum profit? It is total revenue minus total cost. And what is total revenue? Price multiplied by quantity. And what is total cost? It is fixed cost plus the variable cost per unit multiplied by quantity. So these are the steps which have to be followed for optimum pricing. Many students have said that once they cover the entire syllabus, they fail to recollect the steps. So this is the memory tip to remember the steps. Now, Lady Diana can be aptly described as a beautiful and queenly princess. So just see the first alphabets B, A, Q, and P. So this is how the steps work out. You have to first find out B, then A, then Q, and then P. So this will help you to recollect the steps for the examination. Now let's move on to the question. Question number 36. Demand for product S is 50,000 units at the current price of $1,000. Market research has determined that there is a linear relationship between price and demand that is calculated using the following function. P is equal to 1500 minus 0.01 Q. So they have given the demand function. Variable cost per unit of producing product S is $200 and fixed cost is $20 million. What is the maximum total profit for product S? Since the demand equation has already been given, we are already at the end of step 2. So we can just proceed with step 3 by finding out the marginal revenue function. We don't need to bother to find out A and B simply because the demand function is given in the question. So I'll copy the steps here. So the demand function is P is equal to 1500 minus 0.01 Q. So what is the MR function? All that you have to do is multiply 0.01 with 2. The marginal revenue function is 1500 minus 0.02 Q. Now coming to step 4. We have to equate marginal revenue and marginal cost to find out the optimum quantity. So we will write that here. Optimum quantity, marginal revenue is equal to marginal cost, and marginal revenue is 1500 minus 0.02 Q, and the marginal cost is nothing but the variable cost which has been given as $200.
So solving for Q, you get 65,000 units for Q. Now going to step 5, we have to find out P by substituting Q in the demand equation. So what was the demand equation? Demand equation is P is equal to 1500 minus 0.01 Q. And what was Q? It was 65,000. So what is P? P is equal to 1500 minus 0.01 into Q, which is 65,000, which is equal to $850. Now going to step 6, in order to find out the maximum profit, it's nothing but the total revenue minus the total cost. It's price multiplied by quantity minus fixed cost plus variable cost per unit multiplied by quantity. So the price we already found out, it is 850. The quantity we found out, it is 65,000. The fixed cost, it's given in the question as 20 million. The variable cost per unit is given as 200, and quantity we have already found out, it is 65,000. We get the profit as 22250, and that's in thousands. So the right answer is option B. Now moving to question number 37.
A product has a prime cost of $12, variable overheads of $3 per unit, and fixed overheads of $6 per unit. Which pricing policy gives the highest price? Prime cost plus 80%. What do you mean by prime cost? Prime cost is direct material plus direct labor cost, and that is $12. So it is $12 multiplied by 180% because they have said it is 80% plus. So the price comes to $21.6. Option B, marginal cost plus 60%. Marginal cost is nothing but variable cost. So here there are three variable costs. One is a prime cost of $12 and the other one is a variable overheads of $3. So 12 plus 3 gives $15 multiplied by 160% because they've said 60% plus. So the selling price amounts to $24. Now option C, total absorption cost plus 20%. What do you mean by absorption cost? This is the total cost that is including fixed cost. Fixed cost is $6 per unit. So to $15, which is a variable cost, you have to add 6. So 15 plus 6 gives you $21 and multiplied by 120% because they've said 20% plus. So the selling price is $25.2. Moving to option B, net margin of 14% on selling price. Now we know that margin is always calculated on selling price. So do we know the selling price? No, that is what we have to find out. But we know the cost. What is the total cost? The total cost is $21. So we have to establish a relationship between the cost, the margin, and the selling price. Now we know that cost plus margin, which is calculated on selling price, is equal to the selling price. We will equate selling price to 100. And since they've said that margin is 14% on selling price, the margin in this case will be $14. So what is the cost? The cost will be 100 minus 14 or $86. So this is the relationship that exists between the cost, the margin and the selling price. Now we will come back to the question. We know that the cost is $21, which is equivalent to 86. So we are supposed to find out the selling price or we are supposed to find out what is 100. So the answer is 21, which is the total cost, divided by 86 multiplied by 100. So the selling price works out to 24.4. In the question, they have asked which pricing policy gives the highest price. So the right answer is option C because that is the highest among these four. Now moving to question number 38. A new game is about to be launched. Game is unique and can only be played on Star 2000 gaming console, another one of the business's products. So basically there are two products. One is a new game and the other one is a Star 2000 gaming console. And these are complementary products or which can be used together. Students are entitled to a small discount. So if students are entitled to a discount, it means that the non-students are not entitled to a discount. Which three of the following pricing strategies could be used to price the game? First one, penetration pricing. Now in penetration pricing, we charge a low price initially to capture the market. But please note that this low price itself will lower your profit. So you can have penetration pricing only if the product has got a long shelf life. Now, a particular product that's a new game, that will definitely not have a long shelf life. Why? because once a new game comes into the market, that will get outdated. So we just cannot use penetration pricing. Now, price skimming. Price skimming means charging a high price when the product is initially launched, when it is a new and unique product. So definitely it's a new and unique product, so we can adopt price skimming. Now, the third one, complementary product pricing. Yes, the two products, that's the new game and the Star 2000 gaming console, those are complementary products. So we can adopt complementary product pricing. Fourth one, product line pricing. What do you mean by product line pricing? Product line pricing allows companies to target customers with low end, mid range, and high end budgets. Example, hotels offer standard rooms, deluxe rooms, and suites at different price points. Here it is actually a range of similar products which are priced differently. But in our particular case, there are just two products, and it is not a range of similar products which can be priced differently. So, definitely, product line pricing cannot be adopted for a particular product. The next pricing policy is price discrimination. So we saw that we are giving a small discount for the students, which means that the student market has got a different price and the non-student market has got a different price. So definitely it's a case of price discrimination. The last case, variable production cost plus a certain percentage. No, this cannot be adopted simply because we have to consider fixed cost as well. Now, variable production cost plus a percentage can be adopted only for one-off decisions. We can't continue it in the long run. So, for major products, ignoring fixed cost is just not the right option. So, finally, the three pricing strategies that could be used are price skimming, complementary product pricing, and price discrimination. Now, in case of a make or buy with no limiting factors. Now, what do you mean by limiting factor? Limiting factor means direct labor hours are limited, or machine hours are limited, or direct material in kg is limited. In case of a make or buy with no limiting factors, there is no scarcity relating to direct labor hours, machine hours, or direct material. So that's the case of make or buy with no limiting factors. So what should you do? You have to just compare the making cost with the buying cost. And if the making cost is less than the buying cost, then making becomes cheaper, right? So the decision will be to make. And the making cost comprises of the variable cost of making the product, the specific fixed cost, and any lost cash inflow. What do you mean by lost cash inflow? That is just because of our decision to make, we are losing certain cash. So that is also relevant in this case. So that should also be included under making cost. Now let's move on to the question. P is considering whether to make or buy a component. It uses 12,000 of the components each year. The internal manufacturing cost comprises this direct material, direct labor, variable overhead, specific fixed cost, other fixed cost. If direct labor were not used to manufacture the component, it would be used to increase the production of another item which has a contribution of $10 per unit. So just because we are manufacturing this, we are losing the contribution of the other product. So this is lost contribution, but requires $8 of labor per unit. What requires $8? That other product. What is the maximum price per component at which buying is preferable to internal manufacture? Buying is preferable. When is buying preferable? When the buying cost is less than the making cost. So we will first find out what is a making cost. We know that making cost comprises of three elements: variable cost, specific fixed cost, and lost cash inflow. So variable cost, we've got three items: direct material, direct labor, and variable overheads. So that adds up to 8. Specific fixed cost is 2.5. Now relating to the lost cash inflow of that other product. The other product gives a contribution of $10 per unit, but requires $8 of labor per unit. So for $8 of labor cost, the contribution generated is $10. Now, our particular product takes only direct labor cost of $4. So, if you're using direct labor cost of $4, then how much contribution of that other product is lost?
So the answer is 10 divided by 8 into 4. So the contribution lost of the other product is 5. So we include that in our basic format. Finally, the making cost is 8 plus 2.5 plus 5 or $15.5. And what have they asked in the question? When is buying preferred? For buying to be preferred, the buying cost should be less than the making cost. We know that the making cost is 15.5. If at all the buying cost exceeds $15.5, then immediately making becomes cheaper. So as far as the maximum price per component at which buying is preferred, the answer is $15.5 or option D. Now the formula for expected value or EV is sigma px, where p is the probability and x is the outcome. Whenever we have to take a decision, we usually draw a decision tree. The square represents a decision point and the circle represents a chance point. So at the decision point, we are supposed to take a decision whether we have to start business A or whether we have to start business B. And the chance point is if we start business A, then there is a probability that the markets will be favorable and we get a profit of $10,000. Or there is a probability that the markets will be unfavorable and we get a profit of only $3,000. So wherever there is a chance point, we have to calculate the expected value. With this general understanding, we will tackle the next question. A company is considering employing a sales manager. A good sales manager can increase profit by 30%, an average one by 20%, and a poor one by 10%. So what is the decision that they are going to take whether to employ a sales manager or not? Company has attracted a good sales manager 35% of the time. So the probability of getting a good sales manager is 35%, an average one 45%, and a poor one 20%. Company's normal profits are $180,000 per annum and sales manager's salary is $40,000 per annum. So if at all we are employing a sales manager, we have to incur a salary of $40,000 per annum. So this company's normal profit is without considering the sales manager's salary. Based on expected value, what advice should be given? Do not employ sales manager or employ a sales manager. Let's take a look by drawing a decision tree. We will first start with a square, that's the decision point, and we will number it A. And what is the decision that we have to take whether to employ a sales manager or not? So employ a sales manager or don't employ a sales manager. Now, if we don't employ a sales manager, we are just going to get the normal profits of $180,000. So that's what I have written here. And if we employ a sales manager, then the sales manager's salary is $40,000 per annum. So definitely that is an expense. So we will write it as a negative figure here. And then there is a chance. What is a chance? There is a chance that we get a good sales manager, an average one, or a poor one. So we will draw three branches, a good sales manager, an average sales manager, and a poor sales manager. To get a good sales manager, there is a 35% chance, and for an average one, there is a 45% chance, and for a poor one, there is a 20% chance. And what is the difference in normal profits that will take place? A good sales manager can increase profit by 30%. So the normal profits, we know it is 180,000. So if it is increasing by 30%, then it is 180,000 into 130%. And for an average sales manager, the profit increases by 20%. So it is $180,000, which is a normal profit, multiplied by 120%. And for the poor sales manager, the profit increase is 10%. So it is 180,000, which is the normal profit, multiplied by 110%. So the profits works out to 234,000, 216,000 and 198,000. I said that for every chance point, we have to calculate expected value or the EV. So EV at B is given by the formula sigma Px, where P is the probability and X is the outcome. Sigma represents sum. Probability of 35%, which is 0.35, multiplied by outcome of 234,000 plus, because it is sigma. What is the next probability? 45% chance. So 0.45 into 216,000, and the last outcome plus zero point 0.2 multiplied by 198,000. So the expected value at B works out to $280,700. So we will write that amount on top of chance point B, which indicates that this is the average profits that we get at point B. Now we have to take a decision at point A. What is the decision that we have to take? Whether to employ or don't employ a sales manager. Now, if we employ a sales manager, the average profit is 218,700 minus 40,000, which is the salary that we have to pay to him, which means that the net income that we get if we employ a sales manager is 178,700. That is just 218,700 minus $40,000. And if we don't employ a sales manager, we get a profit of $180,000. Which is better? It is better not to employ a sales manager, because if we employ a sales manager, then the profit will drop by $1,300. So that's the decision. Do not employ a sales manager, as profits will drop by $1,300. Regression analysis aims to predict the value of one variable based on the value of another variable. So basically we have got two variables. One is the independent variable and the other one is the dependent variable. For example, the year or the quarter is X, or the independent variable, and sales is Y, the dependent variable, because sales is dependent on the year or quarter. So as the year or quarter increases, the sales may show an increasing trend or a decreasing trend. So basically sales is dependent on the number of years. Now the second example could be labor hours worked. Labor hours worked is the independent variable, which is X, and the production overheads is the dependent variable, or Y, because when the labor hours worked increases, the production overheads also increases. So production overheads is dependent on the labor hours worked. Now to express the relationship between X and Y, we have something called the trend line, which is given by the equation y is equal to a plus bx. So with this equation, it is very easy to find out how y will change when x changes. Now let's start off with the question. Production overhead costs at M Limited vary with the number of labor hours worked. Production overheads vary with the number of labor hours worked, which means that production overheads is dependent on the number of labor hours worked, or production overheads is a y variable and number of labor hours is the x variable, or the independent variable. Further, they have given the year, the production overheads in dollar, the number of labor hours, and the cost index. Now, what do you mean by cost index? It's a cost of a year compared to a base year. And this cost index changes due to inflation, etc. So what does this mean? If you are purchasing goods worth $189 in the year 2004, then if you have to purchase the same quantity of goods in 2005, then you will have to pay $205. So that's the meaning of cost index. If the line of best fit is nothing but the trend line, which is always in the form of y is equal to a plus bx. Based on current, that is 2005 prices, is calculated as, so here is a trend line, y is equal to 127,000 plus 18.66. What did I say y was? Y is a dependent variable, or the production overheads, and x is the independent variable, or the number of labor hours worked. So calculate expected overheads in 2006. If expected production activity is 4,600 labor hours, so they have given the value of x. You have to find out the value of y. And expected cost index is 225. Expected cost index relating to which year? Relating to year 2006. So we have to calculate the expected overheads, or we have to calculate Y. So we will copy the trend line. Y is equal to 127,000 plus 18.66 into the answer. And what did they say the value of X is? X is 4,600 labor hours, which means that instead of X, you have to substitute 4,600 and you have to find out the value of Y. So substituting X as 4,600, we get 127,000 plus 18.6 into 4,600, which is equal to 212560. So that is the production overheads. But that is based on 2005 prices, because they have given the trend line based on 2005 prices. But we don't want the overheads relating to 2005 prices. We have to calculate the expected overheads related to the year 2006. So based on 2006 prices, how will you convert? We know that index for 2005 is 205 and the cost index for 2006 is 225. So in order to convert 212560, which is based on 2005 prices, into 2006 prices, what should you do? It is 212560 divided by 205, which is the 2005 cost index, multiplied by 225. That is a cost index relating to 2006. So thereby you have converted the overheads based on 2006 prices. So the final answer will be 233,298. So the right answer is option C. Before I brief about the additive and the multiplicative model, let's just understand what this seasonal variation actually means. Now, just assume that you are into the business of manufacturing and selling ice creams. Let's take a look at your sales performance over the years. So, this is the sales that you have achieved over a 4-year period. 0 represents the first year of operation. And we have also calculated the trend line, which is in the form of y is equal to a plus bx. So in this particular case, our trend line is y is equal to 1000 plus 100x. And it is represented in the form of this straight line. So what does this mean? Your sales is continuously increasing over the years. But I said that you are into the business of ice creams. Do you think that your sales is a perfect straight line? Agree that it is showing an increasing trend over the years. This is the average sales performance. But if you see the in-between sales performance, you will see a difference and it will appear something like this. And why is your sales curve curving like this? It is because in summer, you have an increased sales of ice creams, and in winter you have a reduced sales for ice creams. But when you're calculating the average sales, yes, agreed, it will be a straight line, because this higher and lower performances just gets evened out and it will be a perfect straight line. But when you are trying to forecast data, you can't forecast it like this. You want to have a monthly prediction, which means that we need to know what is the increase that is happening in summer and what is the decrease that is happening in winter. So this is the meaning of seasonal fluctuations that happen within a year. And the techniques given are, first one, the additive model, and the second one, the multiplicative model. In the additive model, the formula is the forecasted sales is equal to the trend plus the seasonal variation. So the seasonal variation will either be a plus or a minus. We are into the business of ice creams. So in summer, our seasonal variation will be say plus 10. And in winter, our seasonal variation will be say minus 10. So how do you calculate the forecasted sales? Say if the trend is 100, that is the average sales is 100, then in summer, your sales will be 100 plus 10, that is equal to 110. And in winter, it will be 100 minus 10 or 90. That is the additive model in which the seasonal variation will be either a plus or a minus. Now coming to the multiplicative model. In multiplicative model, the formula is the forecasted sales is equal to trend multiplied by seasonal variation. So as an example, if the sales trend is 1000 units, that's the average sales. And they will give something called a seasonal index value. and say it is 108. Then how do you find out the forecasted sales? It will be 1000 multiplied by 108%. So your forecasted sales in summer will be 1080 units. Now you might wonder how the seasonal index will be shown in winter for your ice cream sales. So it will be a number less than 100. Say it is a number 92. So how do you calculate the winter sales? It's 1000 multiplied by 92%, or it will be 920 units. So in short, in additive model, it is plus or minus, and in multiplicative model, it is multiplied with the seasonal index, which can either be greater than 100 or it can be less than 100. Now let's tackle the next question.
ZPLC estimates future sales using time series analysis and regression techniques. Trend equation is y is equal to 25,000 plus 6,500x, where y is the total sales in units per quarter and x is the time period. Seasonal variation index value using a multiplicative model is given. So they have given the index for each quarter. First quarter of year 1 is the time period, reference number 1. What would be the forecasted sales units for the third quarter of year 7? Now, one of the common mistakes that certain students do is, what is the third quarter of year 7? They happily multiply 3 into 7 and they say that it is the 21st quarter. Well, that's wrong. It is not the 21st quarter. We have to take the preceding year, that is 6 years multiplied by 4 quarters. So already 24 quarters are over within 6 years. And then you have to add 3 quarters for year 7. So we are at the 27th quarter. So in short, you're supposed to forecast the sales for the 27th quarter. So we will take note of the trend equation. Y is equal to 25,000 plus 6,500x. And x, we know it's the time period. So since they have asked to estimate the sales for the 27th quarter, so we will substitute 27 in place of x. So the answer works out to 200,500. So this is the average sales because this is the trend line. Now adjusting for seasonal variations, since it is a multiplicative model, the forecasted sales is equal to trend multiplied by seasonal variations. Now the trend, we know it is 200,500, and since it is the third quarter, the seasonal index relating to quarter 3 is 150%. Which means that the forecasted sales is 300,750. So the right answer is option D. Now in this revision slide of correlation and coefficient of determination, I will just highlight the key points that are required for tackling the next question. Correlation establishes how strong the straight line relationship is. And if R, that is the correlation coefficient R, if it's greater than 0.8, then there's a strong positive correlation. And if R is less than negative 0.8, then there is a strong negative correlation. The next point you have to recollect is the coefficient of determination, or R squared. It measures the proportion of changes in Y that can be explained by changes in X. So I'm not dwelling more into this topic. There is an explainer video relating to correlation and coefficient of determination. Any student who has not gone through that, please go through that and then tackle the next question. A company's coefficient of determination between output and production costs over a number of months is 89%. Now in this case, output is X, or the independent variable, and production cost is Y, because production cost is dependent on the output. Which two comments are correct? 89% of the variation in production cost from one month to the next can be explained by the corresponding variation in output. So I've just copied the key points from the previous slide. What is coefficient of determination? It measures the proportion of changes in Y that can be explained by changes in X. Coefficient of determination shows how much Y will change because of X. That's the meaning of coefficient of determination. That's exactly what statement 1 is all about. 89% of the variation in production cost can be explained by corresponding variations in output. Statement 1 is right.
Now, in the question, they have said R squared is 0.89, which means that R or correlation coefficient is square root of 0.89, which is plus or minus 0.94. Now, let's get back to comment 2. Cost increases as output increases. Now, generally, we know that cost will increase when output increases, but this is not always the case. Once we increase the output, we might get a discount, which means that the cost might actually reduce when output increases. So we cannot confirm the second comment, which means that we cannot say that it is correct in all circumstances. Now, going to the comment 3, the linear relationship between output and cost is very strong. Yes, it's definitely strong. We have calculated R to be plus or minus 0.94, and we have seen that if R is greater than 0.8 or if R is less than negative 0.8, there is a strong positive or a negative correlation. Since R's value is plus or minus 0.94, it has definitely crossed this threshold of 0.8, and hence the linear relationship between output and cost is definitely very strong. So statement 3 is also right. Now comment 4, an increase of 100% in output is associated with an increase of 89% in cost. No, that is not correct. It is not the relationship between x and y that is explained by coefficient of determination. Coefficient of determination shows that if the change in y is this much, then 89% is because of x, because coefficient of determination is 89%, and balance 11% is due to some other reason. So comment 4 is not right. Now moving to comment 5, an increase of 89% in output is associated with an increase of 100% in cost. Here again, this comment tries to establish a relationship between x and y. But that's not the case. It is how much of the changes in y is because of x. That is what coefficient of determination is all about. So finally, the right answers are comment 1 and comment 3 only. ZBB is budgeting from the scratch or zero base. Items are included in the budget through a cost-benefit analysis. As benefits are known, each cost is justified. So whenever we are including any item in a zero-based budget, it ensures that each cost is justified. It is not like incremental budgeting where we just add a fixed percentage to the previous year budget. With this understanding, we will tackle the next question. What are the main benefits of ZBB? To identify and cut wasteful expenditure and outdated operations. Well, that's exactly the reason why we adopt ZBB, because in ZBB, we try to justify each cost by doing a cost-benefit analysis. So automatically, all the wasteful expenditure and the outdated operations just get eliminated from the budget. Option 2, to improve efficiency. What do you mean by efficiency? Efficiency means more output with the same input. Now, just by adopting ZBB, the efficiency of the organization is not improved. So, this is not the right answer. Option 3, to keep spending low. This is also not right because ZBB does not say that you have to spend low. If any cost is justified, even if it is a high amount, ZBB might allow it to be included in the budget if the benefit exceeds the cost. So, it is not a question of spending low. Now, option 4, to identify and remove certain contracts. No, absolutely not. ZBB does not want to remove any contract. Any cost relating to a particular contract will definitely be included under the budget if the cost is justified. So, the key driving factor in a ZBB is a cost-benefit analysis. It has got no intention of removing any contracts. Now, moving to the next question. We know that activity-based budgeting is ABC in reverse. Now, in the ABC cost allocation, what do? We move from left to right. But in the activity-based budgeting approach, we move from right to left. Now, in case of delivery cost, we have to identify the cost drivers and the cost per driver. So, initially, we will decide on the number of times that product A has to be delivered from the warehouse or product B has to be delivered from the warehouse. We get a total of it, so it's 135, and we find out the cost per delivery. That is, each time what is the transportation cost that we incur. So that's 2000 per delivery. So what is the budgeted cost? Budgeted cost will be 2000 per delivery multiplied by 135. That's the number of deliveries of the cost drivers. The budgeted delivery cost will be 270,000. See, we have moved from right to left. So that is what activity-based budgeting is all about. Now, the main advantage of ABB is it is suited for high overhead. When the overheads are high, allocating the total cost between the two products based on cost drivers will give a more accurate figure. Reduces non-value adding activities. Now, as an example, we could say inspection cost. Now, inspection cost, if we see the cost driver, it is a number of inspections. So when we estimate the cost under ABB, if the number of inspections is very high, then efforts are taken to reduce the number of inspections. So it definitely reduces non-value adding activities like inspection cost. And definitely the costs are more accurate under ABB because by using cost drivers, there is a more logical method of dividing the overheads between the products. And the main disadvantage of ABB is it is costly and time consuming. Now, the next question is regarding the advantages and disadvantages of ABB. Which of the following statement is not a feature of ABB? It's suited when overheads are low. No, it is suited when overheads are high. Reduces non-value adding activities. Yes, that's a feature of ABC. It's costly and time consuming. Yes, that's also a feature of ABC. Fourth, accurate cost. Yes, that's also a feature of ABC. So since they've asked which of the following statement is not a feature of ABB, the right answer is option 1.